Welcome to CoreLogic's housing market update for November 2021, brought to you by onthehouse.com.au. Australian housing values rose 1.5% last month, a similar result to August and September. However, the trend shows the market's continuing to slowly lose momentum since moving through a peak monthly rate of growth in March of 2021, when values were up 2.8%. Across the broad regions of Australia, market conditions are starting to show some diversity. Perth recorded its first negative monthly result since June of last year, with values nudging 0.1% lower. At the other end of the spectrum, Brisbane has taken over as the fastest growing market, with housing values up 2.5% in October. This was followed by Adelaide and Hobart, with both markets increasing 2% in value over the month. In Sydney and Melbourne, the monthly rate of growth has more than halved since the highs seen in March of 2021, when they reached a monthly growth rate of 3.7% and 2.4% respectively. Across the regional markets, New South Wales and Queensland led the pace of capital gains, while Western Australia was the only broad-based rest of state region to record a marginal fall in housing values. Slowing growth conditions are a factor of worsening housing affordability, rising supply levels, and less stimulus. Housing prices continue to outpace wages by a ratio of about 12 to 1, which is one of the reasons why first home buyers are becoming a progressively smaller component of housing demand. New listings have surged by 47% since the recent low in September, and housing-focused stimulus, such as the Home Builder Grant and stamp duty concessions, have now expired. Combining these factors with a subtle tightening of credit assessments, which went live on November 1st, and it's highly likely the housing market will continue to gradually lose momentum. Although the monthly pace of growth is easing, the annual trend has continued to rise, which is a factor of the stronger growth conditions throughout early 2021. Nationally, home values are up 21.6% over the year to October, with half the capitals recording an annual growth rate in excess of 20%. Across the broad regions of Australia, regional Tasmania has led the nation for the pace of annual capital gains, with dwelling values rising by 29.1%. Unit markets have generally continued to record a lower rate of growth relative to houses, with this trend most evident in the annual results. In the largest capitals, Sydney house values are up a stunning 30.4%, compared with a 13.6% rise in unit values, while in Melbourne, house values rose by 19.5% over the year, compared with a 9.2% gain in unit values. This trend is less evident across regional areas of Australia, where the performance gap between houses and units is relatively small. As housing becomes less affordable, we expect to see more demand deflected towards the higher density sectors of the market, especially in Sydney, where the gap between median house values and median unit values is now close to $500,000. With investors becoming a larger component of new housing finance, we may see more demand flowing into medium and high density properties. Additionally, investor demand across the unit sector could be bolstered as overseas borders open, which is likely to have a positive impact on rental demand, especially across inner-city unit precincts. From a supply perspective, property listings are finally starting to lift, albeit from an extremely low base. Persistently low levels of housing inventory have been a central factor in the upwards pressure on housing prices. Vendors have enjoyed extremely strong selling conditions, while buyers have had limited opportunities to deliberate on a purchasing decision or negotiate on the price. Those conditions are gradually starting to change, with new listings trending sharply higher through spring and total advertised stock levels now lifting from recent record lows. The rise in new listings has outweighed buyer demand, pushing the total number of houses and units available for sale to 141,786 properties, a 6.8% increase in active listings from the recent mid-September low. More listings means more choice for buyers and less urgency in their purchasing decisions. FOMO is likely to remain a feature of the market, while listings remain far below average. There is a good chance, however, that advertised supply will rise further through spring and early summer, which, due to worsening affordability and a subtle tightening in credit availability, may not be met by a commensurate lift in demand. Vendor metrics such as auction clearance rates and days on market and vendor discounting rates all remain at above average levels, indicating that this is still a seller's market. However, conditions may start to rebalance towards buyers later this year or early next year. Brisbane has overtaken Sydney to become Australia's strongest housing market in October. While most cities are losing steam, Brisbane reached a new cyclical high point in March, with housing values up 2.5% for the month. Growth conditions remain skewed towards houses over units, with house values up 2.8% in October to be 24.8% higher over the year. In comparison, unit values were up 1.3% over the month and 10.4% higher over the year. It may come as a surprise to some, but Brisbane unit values are still 2.9% below their record high set back in March of 2010. Brisbane's western suburbs are showing the highest rate of capital gain, up 27% over the year, while Ipswich is recording the lowest rate of growth at 18%. Overall, Australia's housing market is continuing to record an above-average rate of growth, but there are clear signs the market is continuing to cool. Not only is the rate of growth still easing, but we are also seeing more listings coming on the market at a time when housing demand is likely to be dented by tighter credit conditions and worsening affordability. Looking forward, downside risks for the housing sector are rising. Along with worsening affordability and higher supply, there's also the potential for a further tightening in credit policy, and off the back of strong inflation readings, the potential for an early rate hike is a possibility. This month, APRA's 50 basis point lift in the serviceability buffer comes into effect. While we don't expect this will have a remarkable impact on mortgage demand or housing activity, there is the risk that, in response to housing credit rising at a faster pace than income growth, additional credit restrictions could be introduced down the track. RBA credit aggregates to the end of September show the pace of housing credit growth has eased a little over recent months, which may help to alleviate the risk of tighter credit conditions. However, a further rise in high debt-to-income ratio lending, or a further lift in the housing component of household debt, could be the trigger for further tightening. We know from previous rounds of macroprudential policy implementations and the broader credit tightening regime seen during and after the Banking Royal Commission that the impact of tighter credit conditions on housing markets can be significant. The trajectory of interest rates will be a central factor in the housing market's performance over the medium to longer term. Financial markets are already pricing in several rate hikes through 2022, and a growing number of economic forecasters are predicting the first rate hikes to be in late 2022 or early 2023, when inflation is expected to move sustainably within the RBA's target range of 2 to 3%. Higher interest rates have typically been an inflection point for housing markets, with a lift in rates generally corresponding with less growth in housing values or the commencement of a downturn. With household debt near record highs, borrowers are likely to be more sensitive than normal to the cost of debt. A rise in interest rates is likely to be the cue for the housing market moving into a downswing. Although housing risks are becoming more evident, the short-term view is for further growth in values, albeit at a slower rate than what we've been seeing over the previous 12 months. As the economy continues to benefit from easing COVID-19 restrictions, current low interest rates should continue to support demand, along with tight advertised supply levels and improving consumer sentiment. No doubt we'll be watching all these factors very closely over the rest of the year and into 2022. To keep up to date with the trends in between our market updates, make sure you're tuning into the research pages at CoreLogic.com.au.